I would now like to review exercise 8.4 with you, and it's a comparison of the perpetual and periodic system. The following information is available for Johnson Corporation, and they give us the beginning inventory, inventory purchased, freight charges on purchase, paid in cash, inventory returned to supplier, ending inventory sales, and cost of goods sold. Applying both the perpetual and periodic inventory system, prepare the journal entries that summarizes the transactions that create the balance. I'll do the perpetual first and then the periodic. The first one is the purchase of inventory on account. Under a perpetual system, we keep track of our inventory all the time, and you would debit inventory for $155,000 and credit accounts payable for $155,000. Freight in charges on purchases paid in cash. Freight in is actually a part of the cost of inventory, because until you have inventory in hand ready to be used for sale, all the cost incurred to get the inventory to your dock, the customer's dock, as well as preparing it for going to be sold as either manufacturing inventory or retail inventory, you would debit that to the inventory account because it's a part of the inventory cost value, and you would credit cash. Now, they said there was some inventory return to suppliers by Johnson Corporation. So a return means they don't have to pay for it. So that would decrease the accounts payable with a debit and decrease inventory with a credit for $12,000. And that would be because the inventory is no longer in Johnson Corporation's hands. It has been given back to the supplier. The sales on account is $250,000. That's what they sold the inventory for. So you recognize the sale with a debit to accounts receivable of $250,000 and a credit for sales revenue of $250,000. And they gave us the cost of goods sold to be $148,000. So when you sell inventory, you not only recognize the accounts receivable under the perpetual method and the sales, you also have to recognize the cost of goods sold, where you would debit cost of goods sold and credit inventory for the $148,000. There are no more journal entries required using the perpetual method. Now, the periodic system, we don't know inventory values or cost of goods sold until we complete our journal entries, and then we would calculate the cost of goods sold and compare what the cost of goods sold is at the end of the year, and we would compare that to an actual physical count. Whether you're a perpetual or a periodic system, there has to be a physical count of your inventory for auditing purposes. Under the periodic, we use the account purchases, which appears on the income statement. Purchase is increased with a debit, decreased with a credit, and accounts payable. So they purchased the inventory for $155,000, so they debit purchases to increase, and they credited accounts payable because it was paid on account. Now, for the freight charges on purchases, you keep it separate, and freight in, again, would be on the income statement, and freight in is increased with a debit and decreased with a credit. So they would debit freight in for $10,000 and credit cash for $10,000. Inventory reported to suppliers. So you no longer owe your suppliers, so you would reduce your accounts payable with a debit of $12,000 and credit purchases because you've now returned the purchase you made for $155,000. You returned $12,000 to the supplier. Now, under the periodic method, we would just recognize the accounts receivable, the actual sale, which would be a debit to accounts receivable and a credit to sales revenue for $250,000. Now, the end of period, you have to do a journal entry. And in this journal entry, you would debit your ending inventory for $30,000. Your purchases returns for $12,000, your beginning inventory for $25,000, your purchases for $155,000 would be credited, and your freight in. Now, that is the closing journal entry. Well, where do the numbers come from? They gave us the beginning inventory of $25,000, and you would credit the beginning inventory for $25,000, and they also give us the ending inventory of $30,000. So you would debit the inventory ending for $30,000. So at the end of the month, or the end of the year, you would debit the inventory ending for $30,000. So you at the end of the year, you would then have a balance in the inventory ending. Now, your purchase return is a credit when we did the journal entry because you're returning the actual inventory. You can see we actually credit the purchase for $12,000 and debited accounts payable for $12,000. So there we would have to debit the purchase for the return of $12,000, and the beginning inventory was given to us, and we credit beginning inventory for $25,000, and the actual purchases is when you go up to the first journal entry, the purchases is at $155,000, and you want to remove that, so you would reduce that by a credit of purchases for $155,000, and the freight in is also part of purchase, is a purchase type account, and you debit it freight in for $10,000, and you would have to credit at the end of the period freight in for $10,000. And to make your debits and credits equal, that's how you get the cost of goods sold of $148,000, which agrees to the cost of goods sold under the perpetual method. Now let's just do the cost of goods sold. Now I told you all the purchases would be on the income statement, and it's on the income statement to calculate the cost of goods sold. The formula for the cost of goods sold is the first is your beginning inventory of $25,000. You then would take your purchases of $155,000 less your returns of $12,000 plus your freight in of $10,000. So net purchases would be $153,000. So your beginning inventory plus your net purchases would give you cost of goods available for sale for $178,000, less our ending inventory of $30,000 gives us cost of goods sold for $148,000.